Contagion is the name of the game at this stage. We've got the Portugal 2-year bond at very high levels, as well as the Spanish the bond yields as well there. What needs to happen? The governments look like they will default.
I think certainly in the case of Greece, they've got themselves into such a deep hole because how can we call it, sovereign Enronization, if that's a term we can use, where you can hide it, until you can't hide it anymore, and then suddenly there's a problem. So they did conceal it. The Portuguese have been a lot more transparent, etc. But at the end of the day, what we are seeing is the lesson that if you want to go down profligacy avenue, you find out that profligacy avenue has a dead end eventually, and it's also, I think, these countries are the poster boys effectively of spending your way to prosperity. You cannot do it; it just doesn't work. One has to realize that there's wealth consuming spending in the economy and wealth producing activity, and they're not the same, and one really does have to have a good balance between the two. And this is also the end of the line for a lot of the very elaborately constructed welfare states, where your electorates and your electorates are not aligned with your tax base, and you eventually land up in the situation these countries have landed up in.
We've got a lot of positive economic data coming out of the US and countries such as China, failing to lift global markets, Eurozone debt really overshadowing that positive momentum. Would you say that the missing piece in the jigsaw puzzle is the jobs data out of the US?
That's one of the missing pieces, but effectively for the same the reason Greece is in trouble, and we can go down the line, is the same reason why one would say, but the US is, if Greece is, ahead in the queue, the US, UK, etc. are desperately trying to overtake them the way they're going at the moment. Again, an unbelievable spending spree, which may actually also end in tears. So the problem's there, and this really is a developed market crisis as such, because these debt problems, in a sense, were resolved in emerging markets 10, 15 years ago. And I know in South Africa's case, for instance, the one huge gift that our own government has actually given us is that they actually were quite restrained and sensible in terms of the debt. So we start off, when we get into trouble, with a debt to GDP level of about 22% to GDP. The Greeks now sitting over 113%. And at the worst, when our economy should start to come back, etc., you find that it might rise to 45%, very manageable.
If one looks at all the foreign debt problems around the world, will this delay a global economic recovery with the possibility of a double-dip recession?
I suspect that because there's too much debt, that there won't be, that you can actually fail to get the traction. If you like the global economy not getting traction, maybe because there's too much grease about, or something like that. But effectively, if there's too much debt, there's too much reliance on consumer spending to get the economy going, right? And to get consumer spending going, you've got to get consumers borrowing again. And again, one can't help thinking this was what got us into trouble, as leverage, too much debt. And if to get the economy going using those levers, you need credit-worthy borrowers. Okay, and in the US, lots of very, very nice recovery indicators, industrial production doing okay, retail sales are starting to show some revival, etc. But the house prices, some recovery, a little bit of a bounce, and in the last few months it's actually falling off again. And that to me would suggest that there could be a double dip. And then the money supply, they don't have a broad money supply anymore, but M2, for instance, plummeting over this last year right into negative territory after you've taken inflation into account, suggests that that's constraining the economy, and that may well be setting the base for a double dip.
If we look at our own economy, we had the employment figures out of Stats SA, a rate of 25.2% in the first quarter of 2010. Yeah. Is this a cause for alarm?
It's a huge cause for alarm. Huge cause for alarm. And this is why in South Africa we need to start paying attention to our savings rate, because without a savings rate you will not be able to sustain the capital expenditure programs. Already there's strains, for instance, in terms of its affordability, because one then has to resort to tariffs, etc. And without savings, you do not have the resources to buy the economic capacity you need to actually resolve that unemployment and poverty problem. So it's actually quite an important issue, and that savings rate probably is our national emergency.